Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Jared Blikre, your host, and with me is my co-host, Yahoo Finance senior reporter Brooke DiPalma, who's here to connect the dots and to be that bridge between Wall Street and Main Street. Today, we're going to be talking about how options are changing the way investors approach markets and why that matters as AI, concentration, and geopolitics shape volatility in 2026. Our word of the day is options, the market's most popular tool for a quick bet or just plain protection. And on today's Market Show and Tell, we're going to break down a simple hedging strategy in an ETF tracking the NASDAQ 100. We promise to go easy on the math. And this episode is brought to you by the number 4.6 billion. That's the record-breaking number of options contract traded last year on the CBOE's exchanges, how a casino mindset is increasingly gripping large segments of the investing population. And today we are welcoming Amy Wu Silverman, who's head of derivative strategy at RBC Capital Markets, where she helps investors think through options-based hedging and what volatility is signaling. Earlier in her career, she held cross-asset and derivatives research and trading roles at Goldman Sachs, Citadel, and Morgan Stanley. And Amy, you've helped me break down options in a few segments here at Yahoo Finance. Just set the table here for us, 2026, what you're seeing so far.
Well, so far, we were joking that our necks are getting a little bit of whiplash just from all the news that we've been following, both geopolitically as well as economically. And then obviously we're kicking off earnings season. So, it's only been 2 weeks so far, but it has felt longer. And I only think that will continue as there will likely be volatility potholes ahead.
2 weeks and it certainly has felt longer. And I do want to get to today's word of the day, and that is options, which are contracts that give you the right, not the obligation, to buy or sell a stock or other asset at a set price by a set date. And they come in two main flavors or types. A call is the right to buy, and a put is the right to sell. Most people use them for two things: insurance when they're worried about a drop, or leverage bet if they think a move is coming. Amy, there's a lot of math that goes into options. It can be intimidated. So how do you sort of navigate this?
Yeah, it's a great question. And I would say, especially if you're just dipping your toe in options, I would think first about what owning an option means. And I think one of the most important things to know is that the most you can lose when you own an option is the premium paid. So that sounds great to a lot of people. And
Defined risk.
Yeah.
Yes, defined risk, of course. But obviously, that can also mean that you lose your entire investment. So I always think about sizing for investors. It has to be something where you're comfortable with that amount that you could potentially lose all of. And to size that correctly in the beginning is always good practice as you start trading them later on, and maybe in a leveraged fashion.
So know how much you're putting in, how much you're willing to lose here.
So we talked. That kind of touches on owning options. Let's talk about writing options or selling options. When you do that, you face potentially unlimited risk, but there's a lot of different complicated strategies. Just talk to us generally about what happens when you write an option.
Yeah, so exactly as you said, when you write an option, sometimes we call it being, naked short an option, it can be scary. And so there are two flavors to think of that. There are actually some very not scary strategies. So a lot of times people who are looking for additional income, if they're already long a stock, let's just say they're long Apple, they really like it. This is like a long-term bet for them. But then valuations maybe seem like they're getting a little high. When you write an option, when you're selling a call an option on Apple, for instance, you're collecting a premium, but you're also saying, in a way, I'm kind of capping my upside. So I'm getting additional yield. In exchange for getting that yield, I am capping my upside if that call is called away. And I'm okay with that, because at that valuation level, maybe I think that the stock is getting a little rich. Now, an important caveat is to have enough shares that covers whatever the contract size of your option is versus, again, leveraging that. That's probably not a day one trade when you're just dipping your toe in the water.
Exactly, because 100 shares is the minimum contract size for each option. You got a number of predictions for 2026, and I like your first one. We're going to see Momo, YOLO, FOMO vibes have a moment in an unexpected industry, as evidenced by negative skew inversion. All right, let's leave out the negative skew inversion for now. Let's talk about Momo, YOLO, FOMO. in an unexpected industry.
Oh, this is what we've also just been seeing for the past few years.
Yeah, out of left field, something happens, and then suddenly it has momentum, and then you only live once, and you got to get in. Otherwise, you got fear of missing out.
Exactly.
And you have now managed to define all the terms, which is great.
Well, that's my job here.
But look, what I would say is if you kind of look at this market post-COVID, I've really thought of that as its own regime for volatility. And the reason I say that is the factor that has really driven this market is momentum. And when we say that as traders, we actually mean that in a more quantitative way. So you can actually trade the momentum factor. It has like a very specific definition of essentially when price return goes up a certain amount, there's usually a predictive ability of it going up even more. And the reason I say unexpected industry, I was joking with an investor that, it's a quote unquote more boring industries, is that we've seen the momentum already in AI. We've seen the momentum already in your meme stocks. But what I think is really important about this year, guys, is it's a little bit more of a show me year for AI. So we've had all this CapEx expenditure. We've had claps on the back for CEOs saying the word AI in their earnings. But now investors kind of want to know, okay, well, where's the efficiency gains? Where is AI helping you move to more profitability? And so when I say unexpected sector, maybe it's one that's not as sexy, but you're going to start to see those AI efficiency gains. It could
So
be
not quantum, but maybe in traditional medicine somewhere.
Exactly.
Okay.
And I'll tell you, I had a client joke with me that he feels like every time he goes to his doctor's office, it's like, has there been a fire? Like, why am I filling out the same medical form that I filled out 6 months ago, that I filled out 6 months before that? Like, do you have a fire in this office every time?
Yes.
And AI solves things like that, right? Like just kind of very low hanging fruit where these are kind of the industry touch points you'd expect to see them first. And so it could create this momentum in an area that is relatively unexpected, because one thing we have learned about the retail cohort, which really likes to trade call options, which fuel momentum, is they're pretty agnostic to the stocks. They'll trade your 90s cool companies. They'll trade your AI mega cap tech. So it's much more about the underlying theme, not necessarily the underlier itself.
Yeah, we've seen so many companies even team up, like unexpected Walmart, Papa John's even this week teaming up with Google Cloud. So it's just be interesting to see as well plays out.
Exactly. Well, we got to shift gears a little bit because in today's market show and tell, we are sticking with the option theme, and we're going to break down a simple market hedge. We're going to use the Invesco QQQ Trust. It's an ETF with the ticker QQQ, which tracks the NASDAQ 100. So it's heavily weighted to the Mag 7 and chip stocks and general tech trade. Of course, there's some other things in it as well. But let's say you bought the Qs, as they're called, a while back, and you're sitting on some nice gains. You're worried about the party. It might be coming to an end. Is there a bubble? Maybe it's just pausing temporarily. That's your thesis. Tell us, Amy, how you would hedge that by buying a put option.
Yep. So as was defined earlier, a put option, again, if you're owning that option, the most you lose is the premium paid on that option. And it's essentially ability to help you have the option, but not necessarily, you don't have to, but have the option to essentially get that downside exposure. And so a simple trade to look at would be February expiry QQQ puts struck 10% down. And essentially what this trade is doing is it's saying, hey, if I've made decent gains from AI, if I'm worried about valuation, if I think maybe there is an AI bubble and maybe it pops temporarily, how do I capitalize on that? How do I buy myself a little insurance? This is a way to do it where you're breaking even essentially at that 10% strike level plus that premium you paid. You have to go past that premium as well.
Let me just add a couple numbers to that because I know you can't necessarily break down specifics for us. That's fine. So if you take the current price of the QQQ where it's trading right now, it's about $6.15, and you take 90% of that, so 10% down, you get to about $555, and you're going to find a strike price for that. And then we're talking about February expiration of the monthlies. So the monthlies all expire on the third Friday of the month, and that's going to bring us to February 20th by my calendar here. So we're talking about the 555 strike by February 20th. And if this, let's say that the Qs trade all the way down to 500, my max loss, I will get I will be able to offload those shares of the Q Trust at 555, so I don't have to weather the rest of that storm. Meanwhile, the price is already much lower than that. Is that about right?
That's exactly right. And you can think of it as insurance, right? The same way that you would on your house or, on your life. It's a way of paying a small premium for something that has the potential to be a multi-standard deviation drawdown.
You talk about the fear of missing out, though. For those who are listening right now and they're thinking about potentially doing this ahead of the February expiration, but at the same time, they're battling with this fear of missing out following that, what would be your message to them?
Well, I would say this is a way to alleviate the fear of missing out because you haven't actually sold your Qs, but you have bought protection on them. And so let's say that Qs do what they do best, which is they actually rip into February. You do lose that premium paid on those put options. However, you haven't capped any upside. So if that FOMO, that YOLO, and that MOMO keep going, you still own it. And for a lot of people where that has been a driving factor, they don't want to sell those shares. They don't want to lose potential upside. This is a way to systematically get a little insurance for the downside, but without leaving upside on the table.
Amy, great breakdown there. And thank you, Chair, for that breakdown as well. But we do need a quick short break. But coming up, we're talking about the phenomenal growth of retail trading and options. And we'll tell you who's renting the runway on today's Who Wore It Better. Stay tuned. This episode is brought to you by the number 4.6 billion. That's the total number of options contracts traded across CBOE's 4 U.S. options exchanges in 2025. It was the 6th year in a row they've set a new full-year record, and that's thanks to not only the availability of more options, as we now get weekly and daily expirations in addition to the monthlies, but also the incredible demand by retail investors. And I know this is something you're tracking really closely, Amy. We've been at this record level. Could this be another year of this FOMO, this YOLO that we continue to see with that in mind?
So one of my predictions for my volatility 2026 outlook, the reason I wrote it was because I had so many questions from investors about, does retail continue to buy the dip? Do they continue to support the market like they have? Or does something take out this leg of the stool? And so the prediction is, if something does take out the retail demand, it's not going to be something scary, Brooke. It's going to be something shinier. And
gold is shiny.
Gold is shining. Diamonds are shiny. But actually, what I was referring to is just the growth in prediction markets.
Oh, boy.
The democratization of financial markets, the growth in betting markets overall, crypto. So I don't necessarily think something scary will happen this year. I think that retail support will be there. But if you do see any dissipation, it'll frankly be the fact that there are just so many more choices they have to make very specific bets. And that really has structurally changed our market too.
It's been incredible to see the rise of poly market, of other prediction markets really come into the forefront here. And we've been talking a lot about it on the show and perhaps any regulations that could come as well. We'll have to look out for that.
Yeah, I was wondering, is there any translation in the math behind options and what we see in some of these betting markets? Because these are basically binary options. Binary means you have two possible outcomes. You either win or you lose. Any thinking there?
Yeah, that's a really interesting question. I'd say two things. The first is, one of the biggest differences right now is the level of regulation. So they're regulated in very different ways. You think about something like a very liquid S&P option versus something that's in the prediction markets. And the second is liquidity. So think about who is currently making markets on your general vanilla options versus something like the prediction markets. Fundamentally, the math is the same, but the supply-demand balances are very different. And what I would say is, 10 years ago, if you wanted to bet that there was going to be turmoil in Venezuela, you could only go to one place. And the market you're making is still secondary in the sense that it is on some general underlier. Whereas
it's not a direct bet.
It's not a direct bet.
It's an indirect bet.
And now you can bet on that exact thing. So in the future, I think when the liquidity changes for these markets overall, my question is, well, who goes and uses S&P versus using a very specific prediction markets? I really expect to see the landscape change over time.
Yeah, that'll be interesting to track. Any other predictions? I mentioned gold briefly. It is a shiny asset, but I know that's something that you've tracked as well. What do you think of the gold rally so far? And gold itself is a derivative, and then we have options on gold. So that would be a derivative of a derivative. I'm not trying to get too cute here, but is there anything there that you've been tracking that interests you?
Silver?
Silver is interesting too. So one of our predictions was that gold calls and gold call spreads were still going to be good hedges this year. One of the main reasons here is when you go back and you look at what the historic realized correlations have been. So essentially, how has gold moved on days that the stock market has gone down? And it still has been a pretty reasonable hedge relative to other instruments. So something investors ask me about all the time is how is crypto doing as a hedge? And the reality is it's really behaved much more as a risk-on asset, whereas you've actually gotten a decent correlation for gold. So when there is a flight to safety, people tend to go to actual gold versus the digital gold. And we still expect that to happen this year, especially as geopolitical tensions seem to be bubbling. Where do people go for debasement trades? Where do people go for geopolitical risk? It tends to all come to gold. And that's why we're specifically talking GLD calls and call spreads.
It's been interesting to see even this week with the tension between President Trump and the Federal Reserve, people have been turning to gold. But at the same time, Bitcoin also having a bit of a moment here. When you think about that debasement trade that we just couldn't get enough of back in October, where does that stand now?
I think you're probably going to see opportunities to reload on it. You could argue even now is the time to do it. And again, we would probably say if you actually want to hedge, then your gold-based underliers are a more decent hedge when you look at that pairwise correlation we've been tracking. So it behaves much more as an inverse versus just a risk-on asset. And that's why we think, at least for this year, this is going to be something that people continue to come to.
One of the interesting things about options is you can bet that something's going to move, and you don't even have to predict which direction it's going to move. You can also predict that it's going to go sideways, so it's not really going to move at all. And just tell us the way options trades can be structured to make bets on those scenarios.
Yeah, so one thing that I think people misunderstand, but is really interesting about options, is that volatility itself is an asset class. So there are people who we work with all day long. They're not trading if things go up. They're not trading if things go down. They're just trading on the idea that there's going to be more volatility, more jostling. And to give a simple example, if you wanted to take let's just say S&P, and you want to sell both a call option and a put option on the same strike, like what implicitly is the bet you're making? You're making a bet that things stay still. And if things stay still, then you collect that premium. And if things don't stay still, then you're essentially short that volatility that's now gone up. So volatility itself is a way to really scrape this idea that there's additional yield in the market that can be collected.
Yeah, volatility as an asset class is something I've been interested in for a while because it can really give you an upside boost when the market itself is tanking. But you got to be careful out there. All volatility asset managers are not created alike. All right, now we've got a markets take on a classic Hollywood gab show staple. Who wore it better? And when markets feel great, but the world feels shaky, your investing outfit matters. Do you dress for a quick exit or a long stay? And that's the matchup between our two contestants today. You've heard of Rent the Runway. Well, our contestant on the left catwalk is renting the rally, serving short-term chic, a sharp trench coat over a lightweight suit with sleek sneakers that are built for quick exits. The whole look is modular, snap-on accessories, easy to take off, easy to size up or down. And on our right catwalk, it's Buy the House energy. A structured wool overcoat, heavy leather Oxfords, and a giant binder briefcase that screams long-term commitment. This look is built to stay put, and it's structured for the long haul. So, Amy, who's wearing the 2026 market environment better, the flexible renter or the all-in homeowner?
I love this. I would say the first one, and that's one of the pillars of our volatility outlook as well, which is
rent the rally.
Rent the rally when you have the opportunity to do so. And I want to be more clear, which is this is specifically in relation to the rotation that investors have hoped for from kind of mega cap tech growth into more value, equal weight. we've seen fits and starts in this trade for years. And so one thing I've said to investors is rent it. Rent it, get that look. But if it doesn't have sustainability, you won't be burned. One trade we specifically recommended was IWM call spreads. It's a way to get access to the idea that there'll be more small cap value rotation this year. But again, I'm always worried about that FOMO and the MOMO, and that tends to be on mega cap tech and AI. We don't want to lose that either.
Little YOLO too.
Little YOLO too.
When investors are seeing this sort of rotation that we're even seeing to kick off this year, how should they be thinking about taking action on that? Is it already 2 weeks in and too late?
I don't think it's too late at all. And if you look historically, so just look the past 5 years, you've seen fits and starts in IWM, which is your Russell 2000, more of a proxy for value, for small mid-cap, versus something like Qs. But I think a key thing to remember is when you took 2025 said and done, the Qs outperformed the S&P, which outperformed IWM. That doesn't mean there weren't bursts of outperformance in IWM, but at the end of the day, if you were long Qs the whole time, that was the stronger outperformance. I think 2026 will look similar even as people look for rotation trades. That's why you rent the rally in something like IWM. Pick your pockets to own those call options, but don't get rid of your AI trades and your mega cap tech.
For long term.
For
Love
long
it.
term.
We got time for one more here. So just in general, any final words for the viewers, the listeners here about risk management or anything else we didn't talk about?
Yeah, so I would say it's funny because the first time I really took a class in finance was with Burton Malkiel, who wrote the book A Random Walk Down Wall Street.
Ah, yes.
And he was a big proponent of the efficient market hypothesis, which I have learned from 2008 isn't really all that true. The markets are not all that efficient.
Not an EMA chair, yeah.
Not really. It's hard to be in this market and believe that. However, it is true over the long, long term. So I would say for investors out there, if you have the time horizon, you probably have the time to recover. And if you don't have the time horizon, that's when you should be thinking about how do I hedge my portfolio? How do I protect myself? Because I need this money sooner rather than later.
Or maybe just rent a rally for a little bit. Get in and get out. Amy, it's been wonderful having you here. And just a quick recap, talking broadly about options today. And that all comes down to calls and puts, where you have, when you buy them, the right but not the obligation to do something. And depending on the call or put, that's buying or selling. And then if you're going to write them or sell them, well, that can create unlimited risk. So it's very important to understand what you're getting into when you're trading options. But we've talked to plenty of other guests on this program about them. Sometimes you just got to jump in and start small. And we have wound things down here at Stocks in Translation, but make sure you check out all the other episodes of our video podcast on the Yahoo Finance site and mobile app. We'll see you next time on Stocks in Translation.